Thank you for watching the Housing Oregon YouTube channel. Be sure to join our network and get involved in the work that we are doing. If you can, please like and subscribe. It helps us build this channel, which serves as a platform to communicate with our members. This video is part of our 2025 annual conference. We're looking for folks to be on the conference planning committee. Please email info@housingoregon.org.
Great, we're just gonna use this. Hopefully it goes better. You can let me know. Next slide. So what we hope to cover in this session today is we're gonna start by looking at our financial report study. So we're gonna look at what were the goals of this study, what was the scope, looking at what our data set consists of, and then some of the key findings. And then we'll go into a never-before-seen dashboard demonstration, which is very exciting. So this is a public dashboard that allows for more filtering and customization of the data. And then we'll move into talking a little bit about some of the data entry anomalies that we saw in our financial reports that we received from partners, and thinking through some suggested changes to make things better in future years. And then we'll move on to questions at the end. And I just have one sort of unsatisfying disclaimer to make, that this session is mostly on the findings from the study. So really looking at the data analysis, key findings. We'll touch on some of the causes or some of the potential causes for what we're seeing in the numbers, but we won't focus so much on the solutions. Happy to talk about that more in the questions. There's been other sessions at Housing Oregon that have kind of gone more into some of those solutions. There's one yesterday on preservation, and that sort of detailed the $50 million in lottery-backed bonds that Oregon Housing received in the last legislative session, as well as OHCS updates and push updates as well. Okay, so the goals of this study, there were 4 main goals of doing this portfolio financial report study. The first one was to conduct a comprehensive analysis of the ARH, or Affordable Rental Housing portfolio, focusing on identifying trends in operating expenses, but then also other key metrics. So things like DCR, or debt coverage ratio, and vacancy loss. The second goal was to share this information with partners to help the broader community understand key facts about OHCS housing. So we have on our website, we have a report, a 10-page report with lots of narrative that goes into details about our methodology. We also have a data summary that's more charts and tables with lots of numbers and data. We presented at a monthly partner call as well as Housing Stability Council in July, and both of those recordings are available on our website if you're interested. We also have a public dashboard, which we're kind of debuting today, which is very exciting. And then the plan is to update this work every year. So every year when we receive our new year of financials from our partners, we plan to update the report and the dashboard, as well as continue to tweak it, add things to it. This is our first time in a while doing this large of a study. And so I think every year we'll be able to add more information and ways of looking at the data to the report. And if you have any suggestions, please let us know when we get to the question section. Then the third one is to revisit internal processes and underwriting standards. So going through this financial report study really helped all of the staff at OHCS understand how we're reviewing the standardized financial templates that we receive from partners. And it was just a really good way for us to really understand what that process looks like, as well as continued improvements to ProLink and connections to some of our other processes. So our PIPs, or our property improvement plans, and our regulatory and risk rating reports, or RARs. And there were other sessions about that, I think yesterday at Housing Oregon. And then finally, I think most importantly is 4, which is to work with partners on new ways of supporting long-term sustainability of these projects. And I'll just note one thing on underwriting standards. I know this is something that's come up in other sessions. So right now, OHCS is underwriting to what we always have, which is 3% expense inflation and 2% revenue inflation, as well as 5 to 7% vacancy loss. We have not found any examples of any other states or lenders that have changed from these standards. Not that that is a reason to not do something, but we're definitely doing that research on what other states and lenders are doing around that information. Okay, so the scope of what our data set looked like. We have three fiscal years in our data set, FY21 to FY23, and this is mostly calendar years. In these 3 years, we have 1,820 reports. So these are the annual financial reports that we receive from our partners. And this equates to 748 unique properties and 47,000 units. I'll note that this isn't our full OHCS portfolio. Not all properties are required to submit financial reports. So it's mostly projects with 10 or more units that are funded with LIHTC, home, conduit bonds, LIFT, risk share, and E&D. And the last time that we did a big portfolio-wide study was for our FY15 data, and that was in partnership with Meyer Memorial Trust and HDC. So it's been a while since we've been able to do the sort of portfolio-wide study. Of course, our portfolio team is monitoring these properties constantly in other ways through the RARs and the PIPs that I mentioned just a minute ago. But the last big study was in FY15, and at that point in time, operating expenses were $5,200 per unit, which, as you will see, is not, of course, what they are now. The other reason why we have the scope from FY21 to FY23 and why we didn't go back to past years is that ProLink became our system of record in 2020. So this piece of software really enabled us to easily export the data, analyze the data, and filter it in lots of ways. And I'll also note that we aren't the only organization that's looking at our portfolio. A lot of our partners are also doing similar studies. So there's really a wealth of information out there around operating expenses and financial metrics. So NOAA, the Network for Oregon Affordable Housing, they did a study on their portfolio. And then PHB, the Portland Housing Bureau, they did a study in partnership with HDC on their portfolio as well. And there's a lot of really interesting national studies. Novogradac, of course, does a yearly study, mostly on LIHTC units across the country. And then I would note that one of my other favorite ones is coming out of Minnesota. So the Minnesota Housing Stability Coalition did a great report on their data as well. And I think, as we're looking at these other reports, there's many differences between how we're even defining some of these key terms. So for example, we don't all define operating expenses the same way. Oregon Housing and Community Services uses the HUD chart of accounts, and so that's what we base all our definitions and our templates on. And then the other thing to note when you're looking at our numbers and looking at potentially other reports is just the portfolio makeup of, are they mostly LIHTC properties? Are they in the Portland Metro? That sort of thing. Next slide. Okay. So these are some of our key findings. These charts are in our report. And so if you search or Google for OHCS financial report study, this should come up. You'll see links to the report, again, that narrative report that I was talking about, as well as the data summary, and very soon to be the dashboard. We haven't linked it yet, but it will be up there soon. And before I get into some of our main takeaways, I just wanted to define, I think, 4 key terms before we look at what the numbers are. So the first one is operating expenses. So the way that we have looked at operating expenses is that there are 4 main categories: administrative, taxes and insurance, operating and maintenance, and utilities. And I'll note for the way that Oregon Housing looks at operating expenses is that we don't include the deposit to the replacement reserve. And I note that because I know that the PHB study does, and so that's a big cost and a big difference. The second definition is non-operating expenses. So these are things like depreciation, amortization, a lot of non-cash expenses, as well as financial expenses, so things like interest payments and mortgage insurance. So that's operating expenses and non-operating expenses. Then the next definition to discuss is DCR, or debt coverage ratio. Our calculation for that is NOI, or net operating income, minus the annual deposit to the replacement reserve over annual senior hard debt service. And the senior hard debt service is the interest and principal payments, as well as fees and insurance premiums. And we remove the deposit to the replacement reserve when we're calculating DCR, just knowing that this is a mandatory and recurring cost, and so it's a slightly more conservative calculation of DCR. And then the final definition I'll note is vacancy loss. So vacancy loss is calculated as vacancy divided by gross potential revenue. I know this is really technical, but I think it's important to all be working from the same definitions. And what is important to note here, and there was an error in the initial report on this, and so I want to point it out. This metric only considers uncollected rent from unoccupied units. The occupied units that aren't paying rent is under bad debt in administrative expenses, so that's separate. So what you're seeing here is just uncollected rent from unoccupied units. And I'll also note that we went back and forth, and I think there's good reasons to use either, but we used mean and not median. So the first kind of key finding that we have, and I know none of this is a surprise to any of you, but operating expenses rose from $6,306 to $7,621. This reflects a 9 and an 11% year-over-year increase, outpacing inflation rates of 6 and 4%. And the inflation rates we used were Western Region Consumer Price Index. The second piece is on revenue. So revenue was a little bit more of a mixed bag. Revenue did increase. It increased from $9,825 to $10,858. So this represents a 2 and a 9% year-over-year increase. And so I say it's more of a mixed bag because 1 year it did outpace inflation and 1 year it did not. And as you all know, looking at just expenses and revenue doesn't capture the true financial picture of the OHCS portfolio, because it doesn't include really key payments like principal debt payments and deposits to the replacement reserve. And so the third key finding that you see there is that the percentage of properties with DCR under 1.1 increased from 24% to 39%. And so what that is saying is that in 2023, 39% of all of our properties in our portfolio had a DCR below 1.1. And I think 1.1 represents one minimum requirement for modeling a property's financial feasibility. There's many other, maybe even better thresholds to use. That's the one we chose to use for now. So these are the symptoms, and I think the question is, and something that we grappled with because I think it really varies, or what are the causes? I think a lot of the pressures that property owners and managers are facing are external to providers. So we've seen higher inflation, higher interest rates, rising wages, staff shortages, pandemic effects, and supply chain issues. And so it will be important to see what 2024 looks like. I know probably the people in this room know better than me because you're seeing it and you're experiencing it in your properties. But we are at work on putting FY24. We're reviewing all of the financials from our partners right now. And we have granted some extensions to partners that needed more time to get us financials. We're going back and forth with partners, and Katrina will get into that more, but making sure we understand any big changes from year to year. So we're in the process of reviewing and analyzing FY24 data. And yeah, we'll have more information about what that timeline looks like later. And then there's much more, you know, this is one table from the report. There's much more information in the report and in the data summary and in the dashboard. We looked at the data in lots of different ways. So we looked at it by property type, PSH, senior, general/family, and other. And then we also looked at it by property size, based on the number of units, as well as by geography. So we looked at it by Portland Metro versus the rest of the state, as well as in the dashboard, you're able to look at it by county. And so with that, I think I'll pass it to Mandi for a dashboard presentation. Probably right.
All right. Okay, so we're so excited that our work on this report is going to be available to the public as a dashboard. I'm just going to walk you through this operating expense dashboard and show you what it looks like and how it works. The dashboard is currently on our Tableau page, but it will be linked on our financial report page. This is very fresh, and we really appreciate the research team for getting this done right at the last minute for us. All right, so as Kelso said, we have these main filters. So we have county. Under property type, I'll just point out that the other category is a catch-all category. It's really specific, including a lot of housing for people with disabilities and mental illness. And then the PSH category is for any property that has any permanent supportive housing units in it, ranging from 3% to 100% of the units. And then we have the different property sizes just to provide insight into economies of scale. And as Kelso pointed out, the number of reports doesn't indicate the number of properties because one property could have submitted reports for all 3 years. So then we get into financial metrics. So we have net operating income, which is revenue minus operating expense. And I should have stated that all these data points are an average mean, and the figures are per unit unless otherwise noted. So we have the NOI, we have operating expenses, which is separated out below. We have debt coverage ratio, which is only calculated for properties that have annual senior debt service, and income to expense ratio, and revenue per unit. And under operating expenses, we have utilities, operating and maintenance, administrative, taxes and insurance, and payroll. And under payroll, we have all these categories separated out. So we have office, salary, property manager, catch-all category, payroll taxes, and payroll insurance. And so as Kelso mentioned, we have the 4 main operating expense categories: utilities, operating and maintenance, administrative, and taxes, and insurance. Instead of listing payroll as a standalone category, the standard financial template embeds payroll costs within all categories except for utilities. So these costs are totaled in this payroll column, but they're also included in their respective categories. And we have also pulled out individual line items of note for each category. There are many more that are not listed here. So for utilities, we have electricity, gas, and water. Operating and maintenance, we have garbage and security. Administrative per unit, we have bad debt and management fees. And for taxes and insurance, we have property insurance and property tax. And one thing about property tax is some of our properties have tax exemptions, so you might see blanks when you filter down. And this is...
Clarifying question.
Sure.
Is maintenance payroll in maintenance?
Yeah, so the way that payroll works is that all of the individual costs are in all of the other categories. So yes, maintenance payroll would be in maintenance. We just pulled it out because we know that people also want to see payroll together. But then yes, it's in the respective categories.
So we were drilling down on payroll.
Gosh, I don't have those exact line items ready to go, but I can follow up with you after for sure. Yeah.
And this is just a starting point. We are going to update this annually, and we'll continue to add more. So if you have requests or questions, let us know.
So required reserves are not captured in.
The annual deposit to the replacement reserve, correct, but we could add them, definitely. Yeah, so right now, again, this is V1, fresh off the press as of last Friday. And I'll say that we receive profit and loss statements and balance sheets from partners. We mostly focused on profit and loss for the first kind of round. The balance sheet had more kind of reporting errors and outliers that we feel like we have a good handle on now, but definitely could add the annual deposit to the replacement reserve for sure. Mm-hmm. And can you just do a demo of like what it looks like for Multnomah County, for example? So you can use all three filters at the same time, which is super exciting. So if you do Multnomah County, if you do property size for properties over 200 units, the number of reports is 46. So again, that doesn't equate to the number of properties, but that's over 3 years. How many reports did we receive that are in Multnomah County and over 200 units? Great. Okay, I'm going to pass it to Katrina for some data anomaly discussion, as well as talking about the ProLink standard template. And we'll have time at the end, a lot of time at the end for questions, so we can come back to the dashboard or anything else that might be useful.
Thank you. So before I get started, I'd like to know by a show of hands how many folks here either are responsible for submitting financials or work with the person who does? Oh, good, 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 good. I have this need to apologize. I don't know why. So I'm an asset management analyst, and my job is to analyze the annual financials our partners submit, reconcile them, and basically analyze them for financial health and doing a risk assessment. So when Kelso was doing her study, she reached out to me to help understand the anomalies that were found during the study. And so I, with the help of my other admin analysts, Karma Taylor, Doug Schultz, and Sarah McGarity, dug underneath some of these anomalies to figure out what was causing them. And that's what I'm going to share with you today. And before I go on, I want to say, doing this, by going in and doing this analysis, it improved our processes so much. It was a great exercise for us. So there were a lot of benefits to this study. So the data entry anomalies include negative total expenses, negative non-operating expenses, negative DCR, high DCR, positive residential vacancy, and replacement reserves. Negative total expenses. Most of the time when that happened, that was pretty rare, it was because of replacement reserve reimbursements. And many times we'll have replacement reserve reimbursements that aren't offset by the actual expenses because they were either in the previous year or will be in the next year, or an insurance claim reimbursement against a repair or replacement expense. So once again, if we get the reimbursement from either replacement reserves or insurance in 2023, but the expenses hit in 2022, it's going to affect the total expenses for that year. Negative non-operating expenses. Most of those were due to depreciation and amortization being listed as a negative versus a positive number on the ProLink standard template. And one of the jobs that myself and my peers do is reconcile the financials, and we miss some of those. When we go through it, we should be able to catch those, and we miss some. So that's basically corrected on our end, which is what we did. The other category would be an insurance claim recovery, once again for prior year or future year expenses. Negative DCR, and unfortunately that is just happening with our properties that are struggling with high operating costs or debt service expenses. And as expenses go up, with insurance and utilities and salary, we're seeing more and more negative DCRs. And that's just kind of life right now with property management. When we have a trend of that, say 2 or 3 years of negative DCRs, the senior asset management analyst will reach out to our partner and ask to work collaboratively together on a PIP or a property improvement plan to create a plan to improve the financial position of the property. And that is done through different ways. For example, a rent increase or additional funding. There is all kinds of different things they can talk about and do, and it's something that they work together on with our partners. And so if you, like I said, if we have a couple years of negative DCRs, you will hear from the senior asset management analyst and work together to come up with a plan. High DCRs. We don't see a lot of high DCRs, but when we do, it's because some cases the loans were paid off, which decreased expenses. There's a large insurance claim reimbursement. Once again, didn't have offsetting expenses, or a loan converted to interest only. Those will all impact a high and come up with a high DCR, but we don't see a lot of it, and it a lot of times is a one-off. Positive residential vacancy. Instead of a negative vacancy loss, it'll be a positive vacancy loss. And once again, we don't see that a lot, but when it does happen, it's because of subsidy payments received, which offset the actual vacancy numbers, or a property has a mid-year rent increase, or vacancy was input as a positive number, and against your wonderful analysts missed that during a reconciliation, and so we correct that on our end. But usually vacancy loss is a negative number, unfortunately. Replacement reserves, and these weren't so much anomalies, it's just kind of issues with replacement reserves. We've discussed it numerous times already, where we get large replacement reserve reimbursements without offsetting expenses. I think I've already talked that one to death. But sometimes we get replacement reserve reimbursements where the expenses have been capitalized. And so we don't have the offsetting expenses for the replacement reserve, and that throws off the numbers. Or replacement reserve balance is listed as a negative number on the balance sheet or not listed at all, and that's something we have to catch during our reconciliation of the financials. Or annual replacement reserve deposits are not clarified on the template. And the ProLink standard template, which I'm going to talk about more in a second, has a tab where you're supposed to put in the annual replacement reserve deposit amount. And sometimes our partners will forget to fill that in. So that's when that happens, that's when we email the partner. Next slide. Speaking of emailing the partner, I'm sure all of you have gotten emails from us asking for clarification on the financials. And we do year-to-year comparisons. So whenever we see vacancy loss or operating costs, maintenance salary, something like that go up quite a bit, we're going to send an email out asking why. And to show you how often we do that, per my slide, 165 clarification emails were sent to partners in a 4-month period. That's just me. There's 3 more of me's out there, so you can imagine how many. And since I did this slide, I'm up to 200 emails. Just me emailing partners saying, I see a casualty loss expense on your expenses. I need to know more about it. I see that vacancy loss increased by 30%. I need to understand why. We have all kinds of questions. And speaking of casualty losses, I just want to do a quick plug to please remember, when you have a casualty loss, when it happens, you should immediately contact Oregon Housing. Don't wait for us to discover it in the financials, please, which is how we discover a lot of them. If you'll just reach out to either to your asset management analyst or your senior asset management analyst, we have a handy dandy form you can fill out, and we'll ask for a little documentation. It'll make it a lot easier. So if you could remember that, pass it along to the people who deal with that, we'd really appreciate it. So the solution to this, to reduce all these emails from Oregon Housing, which I know takes up your time, takes up our time, is add clarifications to the template or provide additional documentation. For example, on the ProLink standard template under vacancy loss, if you've seen it's gone up more than 20%, add a comment. There's a section for comments on the template and say, we had to do a number of evictions for non-payment of rent, or we had a casualty loss expense, so we had to displace residents. Add a clarification, and then we won't have to contact you. Or, you know, if maintenance costs go up $200,000, you put in there, we had to do parking lot repairs. And we would really appreciate that, and it would, I think, save all of us a lot of time. So, speaking of the ProLink standard template, as you all probably know, it's based on the HUD chart of accounts. But we're very curious as to what other categories you would like to see. They talked about the different categories that are on the template. And it's really difficult to change the template. It's expensive and time consuming. But I'm happy to say that they are already in the process of adding one new category, and that's for resident services. Yeah, it's good news, because right now I think folks have a hard time figuring out where it should go. I see it under maintenance, I see it under admin, I see it in non-operating, I see it in operating. And so we felt strongly enough about it that we were adding that category. I can't tell you exactly when you're going to see it, but it's coming soon. Some other possible new categories that we throw around are partnership fees. That's a non-operating cost, and sometimes I think people aren't quite sure where to put it. Cable expense or casualty loss expense. And once again, I can't say that, you know, if you tell me today what you'd like to see, that it's going to happen tomorrow, but I can at least voice it to the people who do make these changes and see if we can't revise the template to include that. So that is it for my presentation, and now we'd like to take questions, please.
Yeah, if you could raise your hand and I'll pass the mic to you.
And I'll just say, sorry, one more thing before questions. I think, I mean, ask anything. I think the other things that would be useful is kind of, questions about the study or the dashboard, requests about things to add to that, our standardized template, or things to include the next time when we do the study or the dashboard. And then also just, you know, in your own portfolios that you own, manage, or work on, or consult on, how are you dealing with increased operating expenses and other financial metrics? And does it reflect what we're seeing in our data, or is it somehow different? I think all of those would be useful. So yeah, thanks.
I don't have a question about the data, but for the template, if OHCS would like a narrative around year-to-year comparison, I work out of the Portland metro area, and I don't use the HUD chart of accounts. None of my properties have HUD reporting, so it's actually a complete project to implement information into the ProLink template.
Right.
I'm Holly Benelli. You've emailed me a lot. And I think that it would be awesome if there was an automatically generated tab, since you guys provide the ProLink template for each specific property to download out of the Procorum system. If there was an automatic tab that showed the historical data so that I could see if you guys are going to have a reported change in a specific expense category, because I never see my financials in this format unless I'm submitting it to OHCS. So that would then cue me, I mean, things like vacancy, right, it just is, and I know that that's something you would need a narrative on. But some of the other categories just don't match any of my internal organizational reporting. It doesn't match PHB's reporting. So that would be really helpful and could streamline that process.
Really helpful, thank you.
Yeah, thank you.
Well, I'd be happy to respond to it. You know, like I mentioned, it's very expensive and difficult to change that template. And I'm not sure what that would take, so I can't really promise we'll do it. All I can promise is that I will talk to the people who do control it and see if that's something we can do. And just to make sure I understand what you're saying, you want to see a tab that shows the historical data from the previous year so you can see the differences from year to year. Right, right. I mean, I think it's a great idea. but I'm not the person that has the ability or power to do it, so. But I love the idea, and I'm going to take it forward, and I appreciate it.
Hi, I'm Jillian. I'm with Community Partners for Affordable Housing. I have a question about what you were saying on casualty losses. Do you want us to call you anytime? Because for us, there's kind of a different categories, right? There's the major casualty loss where we're making an insurance claim, and that I understand. But for example, in our 100% supportive housing building, we might have a casualty loss that we're going to the risk mitigation pool for a unit turn or a unit flooding, or using replacement reserves. Do you also want us to notify you of every one of the, because then you're gonna get it could be once a month in a PSH building. Okay. It's a lot. Yeah. So I guess, we're happy to call you as often as you want us to call you, but I think you're just gonna get a lot of calls.
Well, I think that anytime it impacts a unit or a common area, and there's, particularly if it displaces a resident, then yeah, we need to know about it. So
Yeah, okay, good to know, thank you.
So yeah, if you need to contact us once a month. And Chrislyn, do you have something to say?
I think I'm gonna say what Chrislyn's gonna say. It's also related to the CCPC reporting. So like you have to say if there's a delay in releasing a vacant unit. And so that's why you want to report your casualty losses to OHCS, because then they have the documentation of the period the unit was down. So when you go to do your reporting on your CCPC, they have an understanding on their side, and it kind of lines up to avoid like a potential finding. Yeah.
Thank you. That contributes to the reconciliation that we need to do on our part with that data, but it also helps Katrina in her review and all the other asset management analysts that do that analysis on these properties understand why there's an abnormality or a blip in the data. So that report will coincide. But I do want to tell you that there's news on the horizon with regard to this, because the definition of casualty loss is anybody's guess, right? I might have one opinion, my insurance company has a different opinion. We're working on rolling out an update to our process and our policy in reporting that's generic and not just casualty loss or incidents, but just reporting. And so keep an eye out for that, and we're also hoping to simplify that reporting process so that it's just a series of questions that come out, and then if there's more information that we need after you answer 4 or 5 questions, we contact you and let you know. So good news on that front, I hope.
Are people currently, in the Procorum template, are people currently reporting the replacement reserve withdrawals as well as the deposits?
Yes,
consistently?
We're requesting, thank you, I keep forgetting about the microphone. We are requesting a general ledger, replacement reserve general ledger be submitted with the financials. We kind of suggested it in our last year's technical advisory. With the new technical advisory that's coming out in January, we are requiring it. So when you upload to Procorum, one of the things you'll be uploading is the replacement reserve general ledger for that fiscal year.
Okay. Yeah,
Does that answer your question?
Yeah. So
Okay.
I think what would be really helpful with the data is also to if you're not including replacement reserve deposits in the operating expenses or anywhere in your dashboard currently, I think showing the totality of the activity would be helpful, because I think a lot of owners can relate to the experience of basically rating the replacement reserve to offset those huge increases in expenses.
Yeah, appreciate that suggestion. That's definitely something that we can add when we add in our FY24 data, for sure.
Hi, good afternoon. My name is Adam Smith. I'm a affordable housing multifamily broker. Quick comment and then a question. Are you advocating or publishing how much you are suggesting for replacement reserves based on age of building? Is that published anywhere?
Oh gosh, I don't think I'm the right person for that question. I have my colleague Mitch here. I don't know what it does. Do we have differences in our requirements for replacement reserves based on age? And potentially Katrina also has something.
Well, I was just going to say, usually the lender is the one that indicates how much they want you to deposit, except for bond properties, which are risk share elderly bond, and so forth. Oregon Housing sets the replacement reserve deposit, and it's not so much based on the age of the property, but we do require a 3% increase each year just to keep up with the aging of the property.
Hey, I'm just curious about the negative net income number that you're reporting per unit, which obviously includes the depreciation and amortization. I'm just wondering who wants to see that? And is that like tax credit investors or, you know, what? I'm just wondering why you have that number.
Why we have the number for net income per unit?
Yeah, because you'll have a negative net income per unit, but also a positive debt coverage ratio, you know. So it's just, I don't know. I'm just curious as why it's a key metric for you.
Sure. And it's probably not the keyest of metrics. I think that net operating income is more useful for sure. So it is possible that net income per unit is a little bit distracting. Net income per unit, of course, includes our non-operating expenses, so a lot of non-cash expenses from depreciation and amortization. And so that's why, one of the reasons why we think that is a negative number, but I think that NOI per unit is a much more useful number to look at.
Does the study break out revenue between tenant-paid rent and subsidy rent?
The template does require a breakout of tenant rent and subsidy rent.
Is that showing that, or is it only expenses?
The study doesn't right now. It just looks at total rent. And so we can certainly, do you mind just repeating that suggestion again? But we can certainly look at adding that.
Tenant-paid rent versus the subsidy rent.
Yeah.
That's paid.
Mm-hmm.
Hi, I'm Sharon. I'm with Reach Community Development as an asset manager. One of my questions, I sat in on a panel today about risk mitigation pool. And with rising insurance costs, we are not submitting claims, if at all possible. So when we get that RMP income, where does that go in the ProLink template?
That's a really good question.
Like other income, and not,
Yeah.
not replacement
It would probably
reserve,
be in the
but-
catch-all.
Okay.
I have not seen that yet. That's a really good question. But I'm going to say just right now that I would want to see it in the catch-all.
Catch-all, and with like a comment saying.
With a comment,
Okay.
please. Yes.
Sounds good.
Thank you. Good question.
One other suggestion for the ProLink template from my colleague Brooks is bad debt expense. Yes. Where does that go? Like, I think right now we're putting it in a catch-all.
There's a bad debt category on the template.
Oh, there is?
Yeah, it's
Okay,
under
good.
administration.
Doing
Towards-
it once a
towards
year,
the bottom.
it's been a while since I've
Yeah,
looked at it.
there's
so,
a separate
okay.
category for it.
Okay, great.
All
Thank
right.
you.
Uh-huh.
And we also have, that's one of the line items that's broken out on our dashboard. So we do have the specific line item of bad debt available for filtering.
Hi, this is Liz Winchester from the Housing Development Center. Thank you all so much for doing this. I think this is awesome. I don't know if you mentioned this earlier, but I was curious if you had an ETA on when the next year of data might be coming out. I know that reporting is still being submitted and still being reviewed, but I didn't know if you had any expectations, because I think we're all eagerly awaiting the 2024 data.
For sure, yes. At this point, FY23 seems very far away. Just to give a little bit of context on how it works, so partners have 90 days after the fiscal year ends, which is most often the calendar year. So they have 90 days to submit their financial reports to Oregon Housing. And then Oregon OHCS staff are reviewing them. They're going back and forth with partners several times, potentially giving extensions to submit those reports. And so I might, Katrina, would you like to give a guess on timeline? I know Chrislyn could maybe also offer some realisticness for this.
Well, we're more than halfway through our 2024 financials, and we do foresee having them completed by the end of the year. But we do have some people, some properties that are on a September due date of September 30th, and so that sometimes they'll ask for another extension. So I can't say that all of the 2024 will be done by December, but the majority of it will be done by the end of December. We've got the staff in place to do it and the processes in place to do it, and I don't see a problem with being pretty much through it by the end of the year, so that we'll have some complete data to work with.
I went from 1 to 3 questions really quick. So my first question is, are you taking just a straight average, or is this a weighted average in terms of the data that you're looking at? Just because the debt service, I think, was like 1.3 or more, but the proportion of projects that are under sort of the baseline of 115 was 40%, give or take, of the project. So I was curious about that. So maybe I'll let you answer that one before I launch into my other ones.
Sure. Yeah, we'll take them one at a time. Yeah, so they're just straight averages. We did, because they are just straight means, we did, and do you mind going back to the scope slide? I skipped over this table that might be useful. But you'll see this table kind of shows how we got to our data set of those 1,820 reports. So starting with the properties required to submit financial reports, and then a little bit of attrition with properties that did submit reports. So some non-compliance, some waivers or extensions. And then we removed 2 key things. We removed ALFs, or assisted living facilities. They just have drastically different financial models. It didn't make sense to compare them in our data set. And then we removed blanks and outliers and those reporting errors that Katrina was talking about. And so because we are taking means, it was more important to remove those outliers. There aren't many of them. Like for DCR, we really evaluated things that were more than 3 standard deviations away from the mean. And then we made sure we just looked at all of the sort of extreme cases. Like there were properties where they had expenses per unit of $2, and that is what their audit said, and it probably was just where they were in the life cycle, but of course it doesn't make sense to compare it to the data. But then on the DCR, so if you could go to the next slide, the way that we looked at it, so the debt coverage ratio, that average, so in 2023, it's 1.34. That's the average DCR for properties that have debt, of course. So not all properties in our portfolio, but just the ones that have hard senior debt. And then the percent of properties with DCR below 1.1, that's the percent of properties out of all the properties in our portfolio that have DCR below 1.1. So they're sort of looking at our portfolio in slightly different ways.
Gotcha, okay. And then my question, actually, thank you for flipping to the side, because I was going to ask if you're tracking like hard debt per unit on the projects, because it would be interesting to see like proportionately if you're looking at like the operating expense per unit, like you could easily deduce like what that average would be if you were tracking hard debt per unit, and know if the projects are potentially over leveraged, like globally speaking. And then my last point, and then I'll shut up, is it'd be would you have any consideration to tracking CapEx? Just because I know we talked a lot about like reserve deposit activity, but CapEx does make a pretty significant difference in terms of like project cash flow. And even though our intention is usually to capitalize for like depreciation purposes, I'm just curious if that's something that you would be tracking per unit.
So on the first one, I think I hadn't thought about looking at hard debt per unit. That's definitely something that we have the ability to do in our data. And can you say more about CapEx?
I'm just curious if you'd consider tracking CapEx, because that's something that, like, in our portfolio in particular, there's a lot of, like, insurance claim losses that we would allocate there to, like, especially if we have reimbursements potentially flowing through there that wouldn't show up necessarily on, like, the replacement reserve GL that you might be looking at. And so I'm just curious if that's something that you would track, because I do think it's a indicator in project, like, financial health and performance, even though it's below the line activity.
Yes, we will look into it for sure. That makes sense.
Thank you. Jonathan at Home Forward. I want to echo Liz's appreciation, and probably the appreciation of many people in the room, for making all this, doing all this work and making all this public. Two things about what to do with this data. Maybe I'm thinking the first one's more of a comment, the second one's definitely a question. This may be a very Portland specific thing and a downtown Portland specific thing, but we have on many of our properties security costs that were just never anticipated. And I think, you know, as projects struggle and they perhaps end up on PIPs, like, it could be as simple as, like, oh, right, you're spending $40,000 a year on security that was just never anticipated. And it doesn't need a lot of analysis, and it just is what it is. And so it might save everybody some work to, I think on one of these slides you broke out security costs, and I guess my suggestion is that when projects are paying for security, it'd be helpful to look back and see whether any security costs were anticipated at the time of closing. And then the second question about how to use this data relates to what kind of conversations are happening within the department between this work and underwriting. Because, Kelso, I heard you say that, like everybody, there's these standard assumptions about 2% on revenues, 3% on expenses. Everybody in this room knows that doesn't happen, especially on the expenses side, especially recently. And so these average numbers, if you just took them and started plugging them into today's underwriting, the reality is you have a project that looks like it would be, you know, starting at a 1.2 and make it to year 15. And the reality is you'd have a project that might start at a 1.2 and be underwater by year 7. And so I'm just curious how this data is going to be used. You know, there's the ORCA section next. And how is this data going to be used when organizations are submitting projects that are going through underwriting in conversations about what are reasonable operating expenses?
Yes, just a small question to potentially end us. But a very important question. I don't think that so this one was really focused on that data analysis, which I know is an unsatisfying answer because the solutions are much more important. I think this question of underwriting, the 2 and 3%, it's come up in several sessions over the past 2 days. And I think that I don't have a good, satisfying answer for you right now. It's certainly something that the department is looking into. I think we've been really, we've asked a bunch of other states, we've talked to other lenders, and everyone is still at 2 and 3%. It's almost like we're waiting on that one. It either needs to be a full industry shift, or we're waiting on that one person to be the one to start, to be the trendsetter. And so I don't think I have good answers for you now, but it certainly is something that especially the development team and the production and resources team are thinking about for new production.
I appreciate that. I think it was an unfair question, so I'm going to own that.
It's a good question.
It's an unfair question, even if it's a good one. But I'll just add very quickly, because I've been on the development side of this for a long time, and the historical answer to that is, like, if you rewind to like 2010, it's sort of like, if you know your operating expenses when you're building under construction is going to open up in 2 years, is going to be something like $5,500 a unit a year, you underwrote at $6,500. And that's on, and in that market, you knew that like you might beat a 5 or 7% vacancy. And between those two things, you can, and hopefully with no inflation on the horizon, you could kind of squeak it out. But, there's always pressure to get as many units produced as possible with limited amounts of gap money. I know the governor's very interested in production. And I think one of the things on the underwriting side, I hope the department is willing to consider is nobody's got a better way to look at this than 2 and 3% escalators. And nobody can reasonably forecast what's really going to happen in year 5, 10, or 15. And so the best thing you can do is come up with reasonable operating expenses, and for underwriting purposes, puff them up. Or start with a 1.3 debt coverage ratio, but you got a few different options. But we have to start. Somebody's asking about debt per unit. I would hope that that's been going down over time, because one of the things that we're learning is that like the more these projects are leveraged, the more their sponsors end up struggling and needing to make really tough decisions when you hit any kind of inflation.
Yeah, appreciate that. Thank you. And I think, there were some interesting things that were brought up in the senior lender update around this, if anyone was there. Like there's ways that more traditional lenders are using stress tests to get around the 2 and 3% underwriting. Looking at a 15-year pro forma, modeling it at the 2 and 3, but also something more like a 3 and 5 to see if you're comfortable with the results at that level. And so I know that those workarounds aren't satisfying in the long run, but there are interesting ways that were brought up in other sessions around some of these same issues. Any final, yeah.
Thanks. Jill Chen from the Housing Authority of Washington County. My question is, do you expect this information so that we could use it in some form of preservation for our affordable housing stock? Because OHCS is the entity that has all the data on all the affordable housing stock. Most of us who are local jurisdictions, we may or may not know when something is falling out of the 30-year regulatory agreement. We don't want to be at year 30 trying to, take over a site or acquire a site. We would prefer to get, say, year 20 or year 22 to look at that. How could we potentially use this data so we can decide how much money we should be getting, so that we can say this particular property, based on just cash or cap rate, the value is X versus Y. So we can do our own valuation and say, do I even have the money to do this?
Yeah, I think that the dashboard, you'll never be able, of course, to get to individual property level information. So the financials are exempt from public record, and we're working on that piece of the privacy around the way that the dashboard is able to be used. But I'm curious if there's other pieces that aren't in the report or the data summary or the dashboard, other types of data that would be useful for more of what you're looking for. Yeah, that makes sense. I think just based on the privacy rules and regulations we're following, it's probably not the dashboard tool that will be able to get to those specific property level questions. Sorry, I know that's not a good answer.
Also, I don't think this is working, but
Yeah.
Jill, we're going to be publishing a 10-year list, 10 years for push. And so that should be published by the end of this month. so you will be able to see what properties are coming to the end of their affordability 10 years out.
Thanks. Building off of what Jonathan was talking about, I'm hoping that OHCS can use this data to make it easier when projects request a rent increase above 5%. I want to say that we do not make those requests lightly. We are a mission-based organization. We do not, I think I can say that's true for everyone in this room. But when we're looking at operating expenses going up 9 and 11% and not being able to increase rents even over 5% without, this should be, I guess what I'm saying is, this should be, here, I'll just talk loud. I've got a big voice. This should be sufficient justification for that increase, right? And we've had several years of 9 and 11% to really limit us. Again, we're not making those decisions lightly. We as an organization, I'm sure every other organization is making them on a building by building level. If we could do it on a unit by unit, if we could really get down there and not impact those who would be most impacted, I think we would. So I guess that's, it's more of a statement than a question. It's to just start considering how to utilize this data. I think it's a really useful data set when it comes to setting those limits on rent increases, because no one takes those lightly. We don't ask for a 7% increase if we didn't really, really need it. So that's thing one. Thing two that I wanted to mention is that having properties that are over leveraged, that have low debt service coverage ratios, is the natural outcome of having a points-based system that was on who requested the least amount of subsidy, right? So I think developers were kind of encouraged to over leverage projects, and I think that is one of the benefits of the new ORCA system, is that we're not scored on how much subsidy we get. There's, or that we're requesting. So I think that hopefully, I hope for all of us that will start to change. But I do think that there is some balancing to be done between revenue and expenses, because a lot of projects are at this point over leveraged and have taken on too much debt. Using $5,500 a unit, I know that one of my first projects at SEPA, that was where we started. So, and now it's at like $9,000 a unit, and that's just unanticipated costs. And I mean, we all know what they are: insurance, security, unit turns, whatever. So I think it's a really great data set, and I've already kind of dug into it and compared our portfolio. It's a really good tool for us as asset managers, trying to manage our portfolio and making sure, are we underperforming? Are we overperforming? Which properties? So that I think is great, and the way you can drill down to like even the county level is really, really useful. So I want to say that all of this, it took a lot of work to put this together, and so thank you for that. And also I hope that we continue to have these conversations and talk about how we can use this data statewide to help implement some improvements and get properties performing.
Kristlyn, did you have your hand up for a
I love the opportunity to say this again, because I've said it several times over the last 2 days. If you think we need a rent, if you think that your property needs a rent increase, then we want to help you get it. And so the data that Katrina has helped support Kelso in developing here is exactly what we need. The problem that we run into is that level
Any other final questions?
I have one more question or idea. I would love to see a data set that just shows properties that have reporting information that are not removed because they're outliers for 2021, 22, and 23. Because right now, this like tells a story of a change, but it's not actually a clean data set, and so it doesn't actually. It's like kind of like it's not totally telling me clearly that this is the trend that's occurring because there's new. It's kind of like when they started diagnosing more people with diabetes, and then it was like shit, everybody got diabetes or or autism in one year. You know what happened? And it's like, oh, people just like learned how to diagnose this. So I think it would be interesting if there could just be like a data set that only shows properties that we have the data for each year. Yeah. Versus like because right now your point is they're adding properties each year, and so the year-over-year change.
Yeah, I mean, I think that's a slightly different research question or way of looking at the data. So yeah, what you're seeing here is what's the average of our portfolio at a point in time. And so we're not looking at, there's properties coming on, there's properties potentially coming off. It's not necessarily the same cohort of properties moving from year to year. And that just wasn't our research question, I guess. We were more interested in what is the average of our portfolio at each point in time each year. So I promise it's a clean data set. We did a lot of data cleaning and a lot of work on removing the outliers. But I think your question of looking at, I'll have to think about that more. Like just picking a cohort and then following that basically. Any like thoughts or ideas around just maybe the largest cohort we can find that follows, or is there a different?
Yeah, I mean, I think you could just look at like as many of the 400 that you have reporting for the 3 years, because I think it does. Even yes, what you're saying, but when like the lay person reads this, they're like, oh, like this was the change over time, and it implies that it's a cohort data set. But it's like, or to me, it reads as a cohort data set because it's just like people don't understand data in that way, right? We're not statistics.
Yeah, makes sense.
But that's already broken out. Like, I feel like if they have just the same properties over time, then they can do all the filtering you want. Yeah. Like, at a subsequent. So you want like a balanced same.
Okay, any other final questions? Anything else panelists want to say before we wrap up? You have 5 minutes. Thanks for coming. Appreciate it.